So welcome everybody. This is Fred Josick, lead analyst for Fuel Cell Technologies Office at DOE. And today's webinar is going to be on the hydrogen financial analysis scenario tool and the updates to the model. And Michael Penna of National Renewable Energy Laboratory will be presenting the slides and giving some demonstrations.
This is Fred. Can you hear me?
Yes.
Yeah, we can hear you now.
This is Carlos. All right. Apologies about that. I was on mute. But yeah, we'll begin shortly. I appreciate Fred's intro there. I just wanted to go to slide 2 just to go over some housekeeping items to attend to. All attendees will be on mute throughout the webinar. So please submit your questions via the question box that you should see on your webinar panel. We will cover those questions during the Q&A at the end of the presentation. So with that, I'd like to introduce, go back to our DOE host, Fred Josick here, joining us from the Department of Energy headquarters in Washington, D.C. He's a systems analysis lead project manager within the Fuel Cell Technologies Office. And, Fred, if you want to take over, back to you.
Sure. So thank you, everybody, again. So as Carlos mentioned, please, if you have any questions that you want answered, that will be addressed at the end of the presentation. Please type those into the question box for the webinar. And so let me introduce the presenter. Michael Penna is a senior analyst for the National Renewable Energy Laboratory, NREL, which is a national laboratory of the U.S. Department of Energy. And in his position, he performs technical and economic analysis for all aspects of energy-related hydrogen technologies. He has 8 years of industrial experience as a lead systems engineer in designing hydrogen and natural gas fuel cell systems at Plug Power in New York. And Michael holds a master's degree in mechanical engineering and a bachelor's degree in chemical engineering, and is currently working on his master's in business administration. So with that, I'll turn it over to Mike Penna. Mike?
Thanks, Fred. Thank you for the introduction. I would like to acknowledge again Fred Josick. Funding for the project has been provided by Department of Energy, Fuel Cell Technologies Office, and Fred leads the Systems Analysis Program. This model has many contributors. It's really a team effort. We've had inputs and work done with the California Fuel Cell Partnership, H2USA Investment and Finance Working Group. We've had work and inputs provided by the California Energy Commission through under California's Governor Office, California Air Resources Board. We've also had extensive input from members that are outside of those organizations, Welford Energy. We've had Curry & Co., Equis, Energy Independence Now as inputs. We've also had a lot of input from folks that do, as you noticed, I'm an engineer to begin with. We've had a number of folks from finance with MBAs that do finance in and out to help me with the some of the algorithms to assure that the models are done exactly as they need to be done for this type of analysis. And also the model has been reviewed externally by not an MBA, but a doctor in business administration, Jeff Grover. He went line by line to assure that the model is done correctly. So overview of what I'm going to do. I'm going to show a brief PowerPoint slide deck. I'm not going to go line by line on the slide deck. I'm going to save some time for the second half of my talk, which would be a live example using Excel. I like live examples. If you would like to tag along and double up what I'm doing, you can either Google H2FAST, and it's typically the first item that comes up, or you can, if you're a very fast typer, you can copy paste that link. Actually, I don't think you can copy it, but enter the link on the bottom of this page, and you can download the spreadsheet version of H2FAST so that you can follow along. I'm going to use, for the demonstration, I'm going to use a blank model as downloaded from the web, so you can have exactly what I have in front of me. So with that, what is H2FAST? It's a financial model for hydrogen systems. And more importantly, what it's not, a lot of questions I get are, how do you estimate the capital cost of piece of equipment, be that a retail station or a compressor or a pipeline? And that's not what this model does. It strictly takes as an input capital cost, maintenance, life of the piece of equipment, its efficiency. Those are inputs to the model. And what it does is it provides a simple interface and performs very rigorous financial analysis. Then that financial analysis is articulated in a way that can be either visual. You can really drill down and see what's happening with cash flows. You can do statistical analysis, etc. The type of users for the model are typically station operators, somebody interested in a particular design of station. Maybe they have something in mind, like a particular incentive package that they want to go after, or a different type of a station or alternatives that they're trying to evaluate. So a lot of retail station owners, government and policymakers, in determining how much incentives may be required for infrastructure. This can be a useful tool to evaluate, well, do we need to incentivize to level A, B, or C? Of course, investors, either equity or debt investors. Also, you have strategic investors who may be gas suppliers, car makers, equipment manufacturers, trying to figure out what they can charge for a piece of equipment and for the market to be relevant to the market. And of course, our friends in academic institutions and other national laboratories. So inputs of the model, again, capital costs, you'll be inputting things like incentives, either grants, operating incentives, take or pay contracts. I'm not going to dive into detail on that one, but keep in mind it's there. You will specify maintenance costs, demand profile, so how quickly do you get up to your eventual dispensing capacity? What is the feedstock use? How much electricity do you use per kilogram dispensed? How much natural gas if you're a reformer station, or how much liquid delivery do you have per dispensed hydrogen? Very importantly, the retail price of hydrogen. And lastly, we'll specify financial parameters. So for example, if you're retail, you might have one set of depreciation schedules, interest rates, but if you're evaluating a pipeline segment that you want to operate, you might have different lifetime of the project. You might not have credit card fees or sales taxes. So you will specify what the financial situation is for the piece of equipment that you're trying to model. The model itself uses a framework of generally accepted accounting principles. GAAP is the acronym for it. One thing to note is that GAAP is a financial framework widely used in the United States. However, there is another framework called International Financial Reporting Standards, IFRS, which is used just about everywhere else in the world in different, slightly different variations of it. But that standard is becoming more popular in the United States. So over time, you might see either different investors interested in financial representation in IFRS instead of GAAP. The level of the model is actually designed in a way that you can represent analysis in either GAAP or IFRS. With that said, the model calculates income statement, does a projection on year-by-year basis for the lifetime of the project. It does a cash flow statement projections, which does, as most of you probably know, it does cash on hand, capital expenditures, financial transactions. And lastly, it calculates a balance sheet which keeps track of the composition of the business between assets, liabilities, and equity positions. For the model output, we have a set of overall performance metrics such as internal rate of return, payback period, break-even price of hydrogen, and I'll show you what those look like, as well as their time series charts where you can pull out any parameter, line item parameter, and you can see how it changes over time if you want to see how your hydrogen sales are assumed year by year, or if you want to look at cash on hand or what have you, you can pick and the model will plot out any of those parameters. We also have a breakdown on per kilogram of dispensed, what is the levelized contribution for all the cash flows associated with the operation, and that means all the cash flows including operating expenses, including financial transactions, and really we break out all of them. And lastly, the model does uncertainty analysis. So if, for example, you don't have a good handle or you have a range of possible interest rates or demand ramp-up years, you can specify those as a triangular distribution. And the model is going to run what's called a Monte Carlo analysis and report out what is the likelihood of you getting an interest rate, getting a rate of return between X, Y, or Z. He'll give you a distribution of possible outcomes. So I'm going to run through, and I'm not going to go through the details of this in the interest of time, but generally speaking, I'm going to run through an example of what are the steps of running the model. As for this example, I'm using a rather complex system called CHHP, combined heat, hydrogen, and power. As you can see, there are a lot of, within the scope of this analysis, there are a lot of different components. You can actually set the model to give you cost contribution for subcomponents. So for example, if somebody owns the production portion of a retail station where hydrogen is produced from natural gas, and then you have a separate system that does the dispensing, somebody else owns that, and you can also evaluate the entire system altogether. You can do that kind of analysis and look at the cost contribution for one and the other component. So step one, you would specify your capital costs, component name in this portion of the sheet. And again, on the live demo, you'll see where that's located. But what I'm showing in here is that you have a system that's broken out, and we have 250 kilogram per day total capacity, and two of the components, one is a $3 million component, the other one is a $1.5 million component, and the total cost is 4.5. The way that this is set up, the user can actually click back and forth and look at the cost breakdown for each of those portions of the system that's being modeled. So once you specify your capital, installation cost, planned and unplanned maintenance, you would go to step two, where you will specify available co-products. As we said, we have some co-products in terms of usable waste heat from this type of system. We co-produce some electricity, and those are reflected here. Also, you would specify the feedstock usage. So we're using, for the production portion, we're using some natural gas. Also, we're using some electricity in the compression, storage, and dispensing. And on the system as a net, this is the feedstock consumption and co-products that are available from the whole system. On step 3, you would provide the prices for product value and feedstock cost. The first item here is probably one of the most important items, is where you will specify your cost of hydrogen. And the way that it's specified is what is the, not cost, price of hydrogen. So what is the retail price that you're going to charge the end consumer? One thing to note about it, and any of those prices, they're the price at the beginning of the project. So the moment that the project is financed, that is the price. And you specify an escalation rate, which is applied for every subsequent year of operation. So if this is the price of hydrogen, the first year will be $10, the second year will be 1.9% higher than that, and it's going to escalate in the compound fashion. You would specify any relevant co-products in the same way. For example, waste heat, how much could you recover dollars per MMBTU from what's the value of that stream, as well as feedstock costs. You will specify your cost of electricity, cost of natural gas, etc. Step 4, the user would go through the financial assumptions, such as if you're retail, do you have credit card fees? Is there sales tax, road tax? You would look at other fixed operating costs, such as rent of land, licensing and permitting, etc., as well as other details on the financing. What is the tax rate? Are you depreciating in different schedules? So for example, if you have IFRS framework, you would use linear depreciation most likely, but for GAAP, you would use makers, and you'll specify the period of depreciation, as well as capital structure, debt to equity financing, just during the financing periods of the project. As an option, step 5, you can specify ranges of uncertainty. For example, if you have an uncertainty on what the capital might cost, the initial value, that $4.5 million, we can specify that it could really be as low as 3.1 or plus minus basically 50%, or it may be even double. Or plus 50%, so it might be between $3 million and almost $7 million. Or the usable waste heat, if it's in a warm climate, you might not actually use as much of the heat. So you can specify as many parameters as you want as uncertainty, part of the uncertainty distribution. So once you've done this, you can run the model. If you've actually, you only need to run the model if the model is running uncertainty parameters. Without any risk analysis, it will just tell you what is the internal rate of return. Profitability index is actually a little more robust way of calculating financial performance. Sometimes internal rate of return doesn't give you an answer, or it gives you multiple answers. So it's not a very desirable parameter for a wide sweep of answers. But profitability index, you're welcome to look it up. It gives you an answer no matter what. Investor payback period, earnings before interest, tax, and depreciation, NPV, estimated break-even leverage price of hydrogen. In this particular example, we're seeing a reporting of the 5th percentile, the 95th percentile, because we did run an uncertainty analysis for this. And as you can see, the most likely value for IRR may have been almost 6%, but it actually could be negative and could be as much as 9.5% for this particular case. there is a graphical distribution. You can, and I'll show you how to click through and see the results for distributions. The model also report out instantaneously as you input. You don't need to run the model to get a Pareto of all the cash that goes into the system, as well as all the cash that comes out of the analysis. So in dark blue, we have operating revenues, and we have also in light blue, we have financial cash inflows, and they're all normalized on per kilogram of hydrogen. Same thing with cash coming out. We have all the operating expenses in dark orange, and in light orange, we have all the financial transactions that are not operating expenses. One little error check, and I've never run into an error with it, but if you add up all the cash inflows and all the cash outflows, they add up to the same number. Which tells you that when you started the project, the bank account was empty. When you finish the project, the bank account is empty again. You've basically what comes into the business scenario comes out at the very end. One very important aspect of the model is that it actually does not use macros. So any calculation that it does is done live, and what that lets you do is use built-in functions of Excel, such as goal seek. So, for example, if you want to calculate a incentive, which would give investor an acceptable internal rate of return, you can actually use the goal seek function, and Excel will solve for you and tell you what the incentive is, or some other parameter. And I'll show that in the live version of the model. With that said, if you've downloaded the model, you're welcome to open it up. I'm assuming, Fred, can you guys see my screen? The Excel on the screen?
Yeah, Mike, we can see it.
Okay. So this is a freshly downloaded version of the model. And just to give you a lay of the land real quick, this portion right here is where you specify your capital costs for each of the stations, operating expenses, etc. So this is where majority of your input is going to be, and you can specify as many stations as you want. You can run, or different scenarios that you're interested in. If you want, you can run 20 different options, and it'll populate, and you can enter different stations, and you can click through and specify inputs for them. Then you have cells that are in blue. By the way, yellow cells is where you have user input. Blue cells, don't touch the blue cells. They have formulas in them. So these cells in here, you wouldn't need to be touching them. Then you have financial parameter and hydrogen demand ramp up parameters that you input in here. You have a Pareto chart. This Pareto chart is always live. You don't have to click anything. The only thing that the model needs for running is to click risk analysis. Outputs, the key outputs are up top. So single value parameters indicating things like internal rate of return from the point of view of an equity investor, profitability index, investor payback period, first year of positive earnings before interest, tax, and depreciation. This is an important parameter for debt financing. You have NPV at a specified discount rate, which is specified at the bottom of the model. But you basically, from a equity point of view, it tells you what is the net present value in terms of the cash flows from and to the equity investors. And also, this parameter here is very important. It tells you, in order to reach the investor specified discount rate or internal rate of return that they're interested in, what price do you need to charge? And here it calculates and tells you that you need to really charge $12.41. One fine level of detail is that the model can either spit out this as an answer, or you can tell it to always use the price of suggested price of hydrogen. So in cell 67, where you specify the price of hydrogen, you can just point to it and say it's equal to that input. And in this case, the model will always converge into a 10% internal rate of return. So let's undo that, and let's run through a quick example. So first thing we're going to do is, since this is a freshly downloaded model, we're going to look at two different stations, if you will. We're going to take all of this input that we specified, and we're just going to delete it. We're just going to hit the delete button. And for the first station, we're going to say, we can specify a street address if you want to. We can say 101 Hydrogen Street Station. We'll say that it has a capacity of 350 kilograms per day. It has a cost of $2.8 million. And we'll say that the station takes about 5% of installed capital, and we'll keep things simple. We'll say the installation cost is part of the equipment cost, so to keep things simple here. Then for feedstock, there are not going to be any co-products. For feedstock, we'll say that this is a liquid delivery station, and if we say that we're delivering liquid, we might have some boil off. So for every kilogram of hydrogen dispensed, we might, as an example, purchase 1% of additional hydrogen. So for every kilogram of hydrogen dispensed, we need to purchase 1.01 kilogram of hydrogen. And also this type of station needs to have compression, which uses electricity. It needs to have some cooling for fast fueling if it's a 700 bar station, and it might use a total of 4 kilowatt hours per kilogram of electricity. So with that specified, as you can see, we can start seeing cash flow analysis. We can look at any of the different parameters that we may want to plot, but let's keep specifying things. The next thing you want to look at is what is the price of hydrogen you want to charge. We'll tone this down a little bit. We'll set the price to $12. We'll say that we can purchase hydrogen, liquid hydrogen, for $6, and we'll leave the price of electricity at 12 cents. So with that, we can already start looking at some of the results. The Pareto chart that's down here is going to tell us that, not surprisingly, the revenue per kilogram of hydrogen is $12. We're not going to worry about the financial cash flows, but cost of delivered hydrogen. Notice that it says $6.06, but we specified $6. That has to deal with that boil off. We had to purchase some additional hydrogen in order to account for boil off. Just to prove to yourself, if I put in 1 kilogram per kilogram of hydrogen dispensed, you'll see that the chart automatically tells you that you pay $6 for delivered hydrogen. So let's leave it at 606. We'll see equipment costs add up to their contribution is $1.60 per kilogram. Maintenance is $1.57, so on and so forth. One thing I want to point out with these charts here, let's look at average daily dispensing. This would be kilograms per day. the way we specified it right now is we've said that we're going to start the project or basically finance the project in 2016. It's going to have 20-year life, installation time of 18 months, demand ramp up of 5 years, and maximum utilization of 80%. So it takes 5 years to get to 80% utilization. Keep in mind that the model will actually keep track of things in a monthly basis. So if I say that the model ramps up in 0 years, you'll see that it took 18 months to construct the project, to commission it. So that first year we only operate half of the year. And also the last year of the 20 years, it operates half of the year. So for example, if we say 12 months, you'll see that it would account for that first year you're going to operate for exactly the whole year, so we have full sales. So let's leave this at 5-year ramp up and 18 months construction period. Another thing I want to point out is I get this question kind of frequently. If you look at investor cash flow, you're going to see this negative cash flow at the end of the project. That stems from the way that debt is being analyzed. If we look at advanced scenarios or advanced interface, you'll see that you have different debt options. Very often when you have a business, you always have a capital structure which has a portion of it as debt. So from a project finance point of view, you're not going to necessarily take out a loan. If we look at total liabilities, you're going to see that we always have an outstanding amount of liabilities. If you're looking at sole proprietor that wants to take out a loan, you can also do that. You can do a one-time loan, and as you can see, you can specify again 20-year period of the loan, interest rate, etc. And the loan is being, the principal of the loan is being paid off throughout the life of the project and not being and not coming out at the very end. So if we look at the investor cash flow in this scenario, you're going to see that negative cash flow at the end disappears. So let's leave this as revolving debt. Generally speaking, revolving debt provides you a higher degree of leverage for the investment, so that you have a better financial performance for equity investors. So this is fun, but what else can we do with it? Let's look at from a policy point of view. If you want, as you can see, this investment right now is performing at 5.6% internal rate of return, but we want to analyze how much incentives, capital grant would you need in order for this investment to be self-sustaining and for you not to have to the investor would be interested in investing in it. So what we can do is use a built-in function. Goal seek, and we're going to say that we're interested in having the internal rate of return equal to 0.1 or 10% by changing one-time capital incentive. And we're going to say calculate, and we'll give it a second. And there we go. It converged. It's saying that you need $688,000. And in this scenario, you have a 10% internal rate of return. Now, let's say that you're not a policymaker, but you're somebody who's producing these stations, and you want to see how big of a stations do I need in order to get economies of scale such that I don't need incentives. So let's put a second scenario here. Let's say 202 hydrogen street station. We're going to say, we'll just put a pacemaker here, 400 kilograms per day, and we're going to use a equation called, when you double capacity of a piece of equipment, the cost doesn't necessarily double. So what we're going to do is use the thing called scaling factor. So we're going to say that the capital cost is, and again, you can type equations in here. We're going to say that the capital cost is equal to the capital cost of the known station times the ratio of the capacities to a scaling factor of 0.6. So just to test this, if we have a 350 kilogram a day station, it will say that it's the same cost. If we go for 700 kilograms per day, you'll see that the cost doesn't quite double. So let's leave this at 400, and we'll use the same rule of thumb that maintenance is 5% of capital. We'll also say that we use the same boil off and electricity ratio, and we don't want to have any incentives. As you can see now, this station is a little bit larger. We have a leveraged IRR of 6.8%. So if we click back and forth, it's actually doing a little bit better, but it's not 10%, and that might be our target. So again, we can use goal seek, and we'll say that we want 10% IRR by changing the size of the station. And the model is going to crunch through, and I don't like round numbers, and we'll just double check. So it's calculating that you need about 600 kilograms per day for this particular station type, so that the economies of scale in terms of capital are adequate. With that, let's look at risk analysis. Some parameters we're not going to know to the level of certainty as we might want to. So let's specify some things that we're not quite so certain about. And the way we turn on the risk analysis is first we need to click the advanced mode here. Then we click risk analysis. We have a button that comes up. We say risk analysis on off. And then for any of the numbers in here, you can actually specify a range. The way that it's specified, it's a triangular distribution. The most likely value is the value that you had already specified. But then you can specify a minimum value of the triangular distribution and a maximum value of the triangular distribution. So for example, let's say that we have an uncertainty of the capital cost of, it could be plus minus 20%. So what we can say is use formulas here and say it could be this times 0.8 up to the capital cost times 1.2. And let's say the maintenance, we'll give it the same spread, that times 0.8, or this times 1.2. Maybe we don't know how much boil off we'll have. We can say that we have 0 boil off up to 30%. We can also look at electricity. We're finding that some stations at low utilization might have higher electricity usage, so we can say ranging from 4 kilowatt hours per kilogram, and we can say it goes up to twice as much. Let's pick a couple more uncertainty parameters. For example, let's say the capital incentive may or may not materialize. And let's look at this station actually. So let's say that the capital incentive might be 0, or it might be 20% higher, so that we can see what the impact is there. Or the demand ramp up, we said it's 5 years, but what if it went from 3, and it could be as bad as 7-year ramp up of demand. And maybe one last parameter we'll pick, we'll say that delivered cost of hydrogen may be worth $5 per kilogram up to $8 per kilogram. So we've specified, I think I counted 10 uncertainty parameters. You can, practically, you can specify as many as you want. Anything that's actually relevant to the model, it will be run. So once you specified uncertainty parameters, you click the evaluate uncertainty parameter. It does 1,000 runs by default. I've done that just in the interest of time. If you do more runs than that, the distributions would look a little smoother, but the results will be roughly the same in terms of percentiles. So it's almost a cosmetic choice. On my computer, I have probably 6 or 7 year old computer desktop. It takes about a minute and a half for the results to be calculated. Notice that next to each parameter there is a button, a circle button. When you click on it, that will tell the model which distribution you want to plot, and you'll see the plot in a second. So you can plot the results. You can plot also the input distributions to the model, so you can see what they look like. So right now we're running at bottom left corner of the screen. It says 1 minute and 12 seconds. And the model's done. It says 100% done. So now a new chart pops up. You can see here it says leverage after tax IRR. And as you can see, there is a distribution of outcomes that is possible. There is a 5th percentile, 50th percentile, and 95th percentile that I report. They're also listed here, at least the 5th to the 95th percentile. One thing, if you remember from your statistics, there is a difference between most likely value, 50th percentile. Those are two different things. They're not necessarily the same. So for the IRR, we had 10% as the most likely value, and we had the 5th and 95th percentile are negative 1.4% and 11%. We can look at also the input distribution. So if we look at our capital costs, this is the values that's in I guess subdued orange color. You can see the distribution, but you can the 5th percentile was 2.4 million, 50th was 2.8, and 95th percentile $3.2 million for capital. And again, you can click through any of those, and it'll tell you what the distribution was for this particular run. If you ever change a number, and you haven't run the distribution, the analysis, it will tell you that you need to rerun the model. One last thing I want to say before we turn over to questions is there is some additional analysis that's performed for 3 of the parameters here. On the results, if you click on profitability index or NPV or price of hydrogen, there will be 2 additional charts that pop down below. One of them is a tornado chart, which basically reports out the effect from going between, for example, delivered cost of hydrogen turned out to be the most important factor. If you have $8 delivered cost of hydrogen, your profitability index drops to 0.53. If it's $6, which is the nominal case, you're at 2.08 profitability index, and at the highest level, at $5, you have the highest profitability index. And you can look at each of the parameters and how they're impacted by the minimums and maximums that are specified for each of the ranges. You also have a waterfall chart. What this means is what happens if each of the parameters is varied in the best possible direction. So for example, if your cost of delivered hydrogen is the most favorable and capital cost was the most favorable or lowest capital cost. And so basically, if all the stars align, what is the best possible outcome? And in this scenario, would have 5.48 profitability index. If you don't like profitability index, we also have these 2 charts for for NPV, net present value, and we also have it for break-even cost of hydrogen. So if you want to look at what is the lowest cost of hydrogen that you can charge given certain number of parameters, it'll give you that. So with that, I would like to turn over to I think Fred has been has been gathering any questions that you guys have had for the model.
Yeah, thank you, Mike. You must have done a wonderful job, because right now I'm not showing any questions. But with that, however, if an investor is looking at, for instance, the impact of subsidies that have been, I'll ask a question. So if you have a entity that's working where there's or planning a station where there are subsidies that would be able to offset the capital cost, can you evaluate that, say that their portion is only maybe 20% of that, to understand what the IRR is on that station?
So let's do a live example. So let's put a third station, and we'll just let's say 303 H2 station. And let's say the entity has a particular capacity of station that they're used to building, and you can say whatever the capital costs, we'll leave the capital cost as it is and the maintenance as it is. We'll just copy the rest, and instead of subsidies being a particular value, you can say it's this times 0.2 or 20% of the capital, and there it is. That's the financial performance. In this particular scenario, we're looking at 9% IRR, 1.9 profitability index, etc. One thing I'll point out is, since we haven't run statistical analysis for the distribution, the charts, just so you're not misled, the charts will give you a warning. If you want statistical distribution of the results, rerun the model. Okay,
thanks, Mike. I mean, one other question. So some entities are located where they get the LCFS, low carbon fuel standard credit. Can you look at that in terms of percent renewables, et cetera?
Yeah, so LCFS, low carbon fuel standard, is typically calculated based off of how much carbon you reduce on unit of throughput. So per kilogram, it might be, for example, 20 cents per kilogram that you get as a credit, or 60 cents if it's completely renewable. There are different amounts. Where you will specify that is in this line here. It says per kilogram incentive, which is intended for one of the items could be LCFS. And let's say that you're not particularly renewable pathway. You might have something like 20 cents per kilogram. And as soon as you punch that in, you'll see it's reflected your IRR change for the project, and also under the incentives, you're going to see per kilogram incentive came live. One thing to note is that as you can see, we have we specified 20 cents, but the revenue came out to 16. We report out real levelized values in here. So if we're not escalating the price of year by year, you have to see that we have zero escalation rate at this time. But if we punch in 2% escalation, you'll see that the LCFS per kilogram incentive, actually no, that's decay rate. Let's put a negative 2%, so we'll escalate it. You can tailor, so we're up to 19 cents. but in any case, it's in there. You can do that. You can specify sunset year. So, for example, if you have per kilogram, let's see if we can pull it up. Why am I not seeing it? It's in there. I'm not seeing it right now. You can specify a sunset year. So if you just want to have LCFS modeled for the first 5 years, and then after that it becomes discontinued, you can look into that, or even you can assign a risk value of, well, it might be available for the next 4 years, and then, or the next 6 years, or throughout the end of the project. You can also specify that as again as a risk parameter. You can say it might be as little as 3 years and as much as 100 years. So basically, the life of the project.
Also, okay, Mike, thank you. And then one question that came in was, are the charts going to be available after the webinar? And yes, they will be. So, and then one other question, Mike. So if you had multiple stations that you wanted to examine, say at different capacities, can you do that? Like stack them?
Yeah. So let's do it as an example here. Let's get rid of these incentives and say that you've had a 350, 360, 370 kilogram per day stations. You can click back and forth and see what's the financial performance of each one of those. Also, the model is set up so that you can look at, if you had a suite of stations, if you had, let's say you own all these 3 stations, you can select, click one to the left here on this arrow, and it will actually tell you if you had all these stations, the total capacity, would be 1,000 kilograms per day. That's the total capital, and it will give you the cash, the financial performance for if you owned and operated all 3 of these stations. One thing to note is that at least at the current version of the model, all of the stations will use the same distribution for hydrogen demand growth. So you can't, at least at the moment, you can't specify that, say, station A comes online in 2016 and next one is in 2018, and they have different ramp-up rates. If that's something that you want to model, you would have to model it station by station individually. But if you have a cohort of stations, let's say stations that are built in 2016, you can look at their financial performance for 2016. One more thing I just want to mention real quick. If you go to the report tables, if anybody wants to really look at the numbers behind the analysis, you have the income statements listed here for each of the analysis years, cash flow statements, balance sheets. And is there any other questions?
Yeah, there's, we just had several questions come in. So these are regarding the discount rate. It says, does the discount rate include inflation as well as capital cost? It looks like the cost of every step in the chain is specified, and the value of every product and co-product is specified. So the model is applicable to any value chain as long as its link is specified.
Right. So I think there were a couple of questions in there. For the discount rate, we're using nominal dollars for financial analysis. So the discount rate is strictly in terms of nominal dollars without the inflation rate being in there. So if you're looking for 10% IRR in light of a particular inflation rate that you're considering, you might want to bump up the IRR or the discount rate to reflect that additional level of inflation that you're trying to overcome. So for we do have general inflation rates as well in here, and that's only used for doing real levelized values in the Pareto chart. So that does not have any bearing on adding to the specified discount rate for the equity portion of the investment. And Fred, I missed the second part of that question. I heard.
Right. Okay, so it says, it looks like the cost of every step in the chain is specified. The value of every co-product is specified. So
yeah,
the model is applicable to any value chain as long as the link is specified, i.e. there's no data input outside the user's specifies that is specific for hydrogen. Is that correct?
Right. So, for example, you can do other analyses. Let's say we'll add one more station in here, and we'll do a steam methane reformer, or actually let's do steam SMR, and you give it some title, and let's say it makes 500 kilograms per day, and I'm just pulling numbers out of thin air. It costs $6 million, has some maintenance to it, and it uses natural gas, and I actually used to design these things, so uses natural gas 0.17 MMBTUs per kilogram, and let's say that it uses 2 kilowatt hours per kilogram of electricity. Now, when you specify that, the model will prompt you that now you need to specify costs for natural gas as well. Electricity is already entered, but since we're talking about natural gas, we can say that we're purchasing natural gas for $10 or $2, and there you have a analysis for a steam methane reformer, and the breakdown will show you how much you're paying $1.70 per kilogram for the natural gas, and it will give you the breakdown, etc. One more example, if you don't mind, we'll add one more. We'll say that we have a piece of pipeline, and let's 1 mile. Let's say you want to connect to an existing steam methane reformer, and you want to just have a pipeline connecting you, and you have a capacity of 2,000 kilograms per day. That mile of pipeline might cost you $1 million bucks, and it'll basically have zero maintenance, and there will be no utilities or anything like that for it. Since we're not retail, we'll zero out credit card and sales fees and rent, and now you have the performance for a pipeline. And it says for this particular scenario and flow rate, you're paying roughly 23 cents per kilogram of hydrogen per this 1 mile of distribution. And that actually sounds pretty high. I think we need to look at some of the, lifetime of the project is probably longer. We're probably looking at 60 years for a pipeline.
Okay, Mike, so here's another question regarding the cost of hydrogen. Can you use the model to run an electrolyzer case, i.e. the cost of hydrogen versus electrolysis? Yes, absolutely. Let's put an electrolyzer system here. We'll say we have electrolyzer Y, and we'll just give it, you can put any names in here. It doesn't really affect the model. Let's say that it has 120 kilogram a day capacity, and I'm pulling really numbers out of thin air, but let's say it's $1.5 million, and it takes 10% of capital to maintain it. Now for electrolyzer, it wouldn't have any co-products, but it's going to use a lot more electricity. I've seen electrolyzers completely retail. It might be closer to 70 kilowatt hours per kilogram. If it's just production, might be 60, 65. So let's just look at the production portion of the electrolyzer, and that's an electrolyzer.
As you can see, cost of electricity in this case would be $7 just for the electricity costs. You will have maintenance of almost $5. The cost of hydrogen fully would be worth almost $19. And we can actually set that here so we can see it with the suggested price of hydrogen. So the break-even price of hydrogen would be almost $19 for this scenario. And you can look at, well, how much do you need to incentivize the system? Just looking at cost of electricity and maintenance, I don't think even if you pay for all the capital, I don't think this one would really, it gets down to $10 if you pay for all the capital out of incentives. So there's some happy medium in there. Now let's say that you want to look at actually, you know what? I can throw examples all day. Are there any other questions, Fred?
Yeah, I guess one other one that came from overseas: is it possible to model a central electrolyzer hydrogen production and a distributed model, and also on-site electrolyzer model located at a refueling station? Can do that.
Yeah, we absolutely. That's one of the things that we do with this model is look at any supply chain. You can model the individual portions of the supply chain. So if you want to model the electricity production and what it takes to deliver it to a forecourt or distributed station versus if you have at a central location and then you have to pay for a pipeline, then you have to pay for a truck. You actually absolutely, what you would do is you would specify for a central location, you would say, this is my central electrolyzer. Then you would have then you will specify, you might have a compressor for pipeline. You would have a pipeline, and then you have distributed station number 1, or you might have trucks. You can specify in user-defined units. You can define diesel being used for driving the trucks, and then you can one thing you can do is also total supply chain, and you can say that's the that capacity, the sum of all the capital costs. So absolutely, that's something that we do. Now, some pieces of equipment might have a different depreciation or lifetime. You can get a little bit more involved by calculating each of the components with what's their cost contribution in terms of dollars per kilogram in light of them having different lifespans. So if you want to even break down a compression, storage, and dispensing a retail station, and you want to have the compressor to be a 5-year item or 10-year item, and the storage might be a 20-year item, you can actually break down and do a lot more detailed analysis with this.
Okay. Well, Mike, it's 5 minutes past. Obviously, we had some other questions roll in, but what we'll do is try and get those answered offline. Okay. And I appreciate your participation, Mike, and presenting the tool and some examples. It's been very valuable, and we appreciate everybody participating in the webinar and look forward to having people participate in the future. And thank you at this time. Bye.
Thank you. Bye-bye.